#ROTH IRA loophole script. Your financial advisor makes more money when you don't know this one number, and it could cost you $7 million by retirement. In the next 8 minutes, I'm revealing the exact Roth conversion strategy that wealthy families use to legally eliminate taxes forever. Stay tuned. So here's what happened to my buddy James. He's a software engineer making about 180 grand a year, which sounds great on paper. But every April, he'd get absolutely crushed. We're talking $40,000, $50,000 in taxes some years. And one day, his neighbor, who makes the same salary, casually mentioned he paid almost nothing in federal taxes that year. Same income, completely different tax bills. James was confused. His CPA was confused. His financial advisor, he didn't want to talk about it at all. And that's when something clicked for me. The financial industry doesn't want you to know about this because it cuts directly into their profits. Here's the villain in this story. Your financial advisor is incentivized to keep you in the dark. Most advisors charge you a percentage of your assets under management. When you use this strategy properly, you move money out of taxable accounts and into Roth accounts that never get taxed again. That's less money they manage, less fees they collect. Year after year, we're talking hundreds of thousands of dollars in lost fees over your lifetime. So they stay quiet. And the crazy part? This isn't some sketchy tax loophole. The IRS literally wrote the rules. It's called a backdoor Roth conversion, and it's completely legal. But because it's not flashy, because it doesn't involve cryptocurrency or some get-rich-quick scheme, hardly anyone talks about it. Meanwhile, the wealthiest families in America are using this every single year to build massive, tax-free wealth. Let me break down why this matters for your life. The average American earner is going to pay roughly 30 to 40% of their lifetime income in taxes, maybe more if you live in a high-tax state like California or New York. But here's the magic number. If you max out this strategy, you're potentially looking at saving $7 million or more by the time you retire. That's not an exaggeration. Let me show you the math. Let's say you're 35 years old right now. You have 40 years until retirement at 75. If you can shield just $20,000 per year from taxes using this method, and that money grows at an average 8% return, which is actually lower than historical market averages. By the time you retire, you've got about $2.3 million in completely tax-free money. But that's assuming you're only converting 20 grand a year. Most high earners, they're doing significantly more. Now let's add the compounding effect. That $2.3 million is sitting in a Roth account. It grows, it compounds. And here's the critical part. When you retire and you're pulling from this money, there's zero federal tax. Zero. Your withdrawals don't count as income. They don't affect your Medicare premiums. They don't trigger the taxation of Social Security. You just take the money out, completely tax-free. Compare that to a regular IRA or a 401k. When you hit 73 years old, the government forces you to take mandatory withdrawals from those accounts, and every penny is taxed as ordinary income. You have no choice. Your financial situation doesn't matter. They want their tax money. But a Roth, there are no mandatory withdrawals while you're alive. The money just sits there, growing, tax-free, for as long as you want. You can pass it to your kids completely tax-free. It's one of the last genuine tax advantages left for middle-class and upper-middle-class people. So how does this actually work? This is where it gets simple, which is probably why advisors don't talk about it. First, the mechanics. Most of you probably have a traditional IRA, a 401k, or both. You might also have a high income that prevents you from doing a direct Roth contribution. The IRS has income limits. If you make over certain thresholds, and in 2024, that's around $146,000 for single filers, you're not allowed to put money directly into a Roth. It seems like the government is preventing you from doing this strategy. But they're actually not. Here's the loophole that's not really a loophole. You make a contribution to a traditional IRA with after-tax money. That means you're not getting a tax deduction for it. It's money you already paid taxes on. Then, and this is the key, you immediately convert that traditional IRA into a Roth IRA. Since you didn't get a tax deduction on the traditional side, you don't owe taxes on the conversion. You just move the money from one account type to another. Boom. That money is now in a Roth, and it's going to grow tax-free forever. This is the backdoor Roth, and it works every single year. Now, there's a complication called the pro rata rule that I need to explain because this trips up most people. If you already have money in a traditional IRA, which a lot of people do, the IRS looks at your total traditional IRA balance and treats the conversion proportionally. Basically, they assume part of your conversion is pre-tax money, and you'd owe taxes on that part. This is where a lot of people mess up. They think they can't do a backdoor Roth because they've already got an old 401k sitting around. But here's the move. You roll that old 401k into your current employer's 401k plan or into a solo 401k if you have self-employment income. Once the traditional IRA is empty, the pro rata rule doesn't apply anymore. Then you can do unlimited backdoor Roths. This alone could save you hundreds of thousands in taxes over your life. The second strategy most people miss is the mega backdoor Roth. This is for people with really high incomes or self-employed people. Instead of converting the $7,000 you're allowed to put into a traditional IRA, you can contribute way more into your 401k as after-tax contributions. We're talking $23,000, $24,000, even $30,000 extra per year, depending on how your plan is set up. Then you convert all of that into a Roth. Wealthy families are doing this every single year, and their advisors don't tell them because it doesn't generate additional fees. The third piece is timing. Most people do this conversion all at once at the end of the year. But here's what sophisticated investors do. They're strategic about it. If you anticipate a low-income year, a market crash year, or early retirement year, you do the conversion then. Your tax bill is lower because you're converting at a lower valuation. You're locking in massive long-term gains at minimal tax cost. And fourth, you're reinvesting the tax bill instead of taking money out of the Roth to pay it. This is so important. When you do a backdoor Roth, you owe taxes on any earnings that happen during the conversion. Most people pay that tax from their Roth account, which defeats the purpose. Instead, you pay it from your regular, taxable bank account. That way, every dollar stays inside the Roth, growing tax-free. These are the moves the wealthy families know about. These are the conversations that happen between ultra-high net worth people and their CPAs. And if your financial advisor isn't bringing this up, that should tell you something. They're not protecting your interests. They're protecting their fees. Here's what you need to do right now. First, check if you're eligible. Most people are, especially if you've got a 401k at work or self-employment income. Second, audit your current retirement accounts. If you've got money in a traditional IRA, a SEP IRA, or an old 401k, you might have the pro rata problem. Get that handled by rolling it into your employer's plan. Third, find a tax professional who knows this stuff, not your regular accountant. You need someone who specializes in high-income strategy. This will cost you maybe $500 to $2,000 for a consultation, and it'll save you tens of thousands in the first year alone. Finally, set up a backdoor Roth as part of your annual routine. Do it every year if you can. Even if you can only do $5,000 or $10,000 a year, it compounds into serious money by retirement. Your financial advisor isn't telling you this because they don't make money when you use it. But your future self is going to be incredibly grateful that you did. This is the difference between retiring with $3 million and retiring with $10 million. This is the difference between choosing when to retire and being forced to work extra years because you didn't know about this. The strategy is legal. The opportunity is real. And right now, you have an advantage because you know about it and most people don't.